Hey everyone, and welcome. Today, we're going to talk about something really interesting that's popping up all over the startup world. It's called a safe note. And if you're a physician investor, this is definitely something you'll want to understand. Okay, so here's what we're covering today. We'll start with the basics. What on earth is a safe note? Then we'll jump into the good stuff, the upside for you as an investor. But, we have to be realistic, so we'll also cover the potential downsides to consider. And we'll wrap it all up by helping you think about whether a safe note is the right fit for your portfolio. All right, let's dive right in. So what is a safe note? Well, it's kind of unique. It's not a loan, so it's not debt, and it's not quite stock, so it's not exactly equity either. Think of it as this clever hybrid that lives right in the middle, specifically created to make investing in early-stage companies simple and fast. Okay, so here's the deal in a nutshell. You invest money into a startup now, and in exchange, you get a promise, a contract really, for stock in that company later. Now, when does later happen? That's the key. It happens when the company goes out and raises a big official round of funding, from venture capitalists who set an actual price per share. That's when your investment converts from that promise into real shares. Now, you might have heard of something called a convertible note. Think of that as the safe note's older, more complicated cousin. A convertible note is basically a loan. It has an expiration date, it earns interest, all that stuff. But a safe note, it throws all that complexity out the window. It is not a loan. There's no interest ticking up, there's no maturity date where the company has to pay you back. It's just a simple, straightforward agreement that says, hey, when we raise money, you get stock. Okay, let's get to the really exciting part. The reason why people get into this game in the first place, the upside. This is where safe notes can be incredibly powerful, especially if you're one of the first people to believe in a company that's about to take off. So if you're a physician, you're busy. You're looking for opportunities that have real growth potential outside of the usual stocks and bonds. Well, this is it. Safe notes give you a ticket to get in on the ground floor with startups, long before they're household names. And the terms are designed to give you, the early investor, a major advantage. We're talking about things like valuation caps and discount rates, and we'll dig into those in a second. On top of all that, it's fast, it's simple, and yeah, the potential for a massive return is absolutely there. All right, let's talk about one of the coolest perks, the discount rate. It's exactly what it sounds like. A common rate is, say, 20%. So what does that mean for you? It means when the big shot investors come in later and pay $1 per share, you get your shares for just 80 cents. Right off the bat, you're getting a 20% bonus on your investment. It's a huge built-in advantage just for being early. Okay, now for what might be the single most important term in the whole agreement, the valuation cap. Think of it as a price ceiling, just for you. It locks in the maximum price you'll pay for your shares, no matter how successful the company becomes. So let's say you invest with a $10 million valuation cap. The company then explodes in value and raises its next round at a $50 million valuation. Great news for them, but even better news for you. Because of that cap, your investment converts as if the company were still only worth $10 million. It's how the deal rewards you for taking that early risk. And just to give you a ballpark, in something like early-stage health tech, you might see caps anywhere from, say, $8 to $15 million. And yeah, this quote just says it all, doesn't it? The valuation cap is the most important term for a safe note investor. It locks in your upside. That's really the heart of it. It's the mechanism that protects you and makes sure you get the full benefit of your early faith in the company. So here's how the perfect scenario plays out. It's a lot like being an early backer of a game-changing clinical trial. You, as a sharp physician investor, spot a startup with a truly innovative idea. You get in early with a safe note that has a good valuation cap. Then the startup just knocks it out of the park. They grow, they hit their milestones, and they attract a big Series A funding round. That's when your safe note does its thing. It converts your investment into a significant piece of the company, but at that much lower capped price. You're rewarded for your foresight. Big time. But, okay, let's pump the brakes for a second. An investment that offers this much potential upside, well, it's not a free lunch. There are real risks involved. And it's absolutely critical that we talk about the downsides. Because honestly, this is not the kind of investment you make with money you can't afford to lose. Seriously. So what are the big risks you need to have on your radar? Well, first off, your investment might never even convert to stock. If the company doesn't raise that big funding round, your safe note could just sit there. Second, and this is the big one, the startup could just fail. And if it does, your investment is gone. Poof, zero. Then there's dilution. Even if they succeed, they'll issue more shares in future rounds, which means your piece of the pie gets smaller. You also have basically no say in how the company is run, no voting rights, no control. And finally, your money is locked up for a long, long time. You can't just sell this like a stock. And that first point is a really important one to think about. What if the startup doesn't fail, but it also doesn't become a rocket ship? What if it just becomes a nice, profitable little business that never needs to raise millions from VCs? Or what if they just can't convince investors to give them more money? In either of those cases, your safe note could be stuck in limbo forever. It might never turn into the stock you were hoping for. And the numbers behind early stage investing are, well, they're pretty sobering. The brutal truth is that the vast majority of startups, something like 75%, just fail. They go to zero. And the massive home run successes that we all read about, that's maybe 1%. One. This is a high risk, high reward game. The whole model is built on the idea that most of your investments will fail, but you're hoping for that one huge win to more than make up for all the losses. You really have to be okay with those odds going in. Okay, so we've seen the incredible potential, and we've looked at the very real risks. The big question now is, putting it all together, how do you figure out if investing in a safe note makes sense for you and your financial plan? Here's the bottom line, really. Safe notes are not a replacement for your 401k or your index funds. They belong in a very specific small slice of your overall portfolio, the part that you've set aside for high-risk, high-reward ventures. I'm talking about alternative assets. This is absolutely not money for retirement or for your kids' education. It's capital that you have to be fully prepared to lose, invested with a very long-term view, think 5, 10, even more years, all in the hopes of hitting one of those venture capital-style home runs. Please visit synaptichealth.com to see if this investment is right for your portfolio.